What if the world's safest investment just became its biggest red flag? On June 12th, the US will try to sell $22 billion in 30-year bonds, but honestly, nobody wants them. Behind the scenes, investors are quietly walking away. China, Japan, even Wall Street is holding its nose. Yields just hit a 20-year high. Foreign demand is collapsing. And Washington's answer: tax the very country still willing to buy. Moody's has already issued a downgrade. China and Japan are unloading treasuries. And Wall Street, it's bracing for what traders now call the most dangerous bond auction in modern history. This isn't a funding problem, it's a trust collapse. And yeah, it's already underway. On June 12th, the US Treasury will attempt to sell $22 billion in 30-year bonds, a transaction that's usually buried on page 14 of the business section. But this week, it's front-page news, with the 30-year yield recently brushing 5.15%, its highest since 2007. Investors are demanding a premium to lend to Washington, not because they expect inflation, but because they're losing confidence in America's fiscal compass. Moody's downgrade of the US credit outlook last month really underscores the market's concern. $36 trillion in national debt and a government spending trajectory that even internal critics like Representative Thomas Massie call a debt bomb ticking. The auction isn't a formality anymore, it's a referendum on US credibility. And what happens if buyers hesitate? The fallout won't be confined to the bond pits. Unlike previous cycles, long-duration Treasury demand is deteriorating just as issuance hits historic highs. According to Bloomberg, foreign central bank participation in long-end US debt auctions has fallen 29% since January, and May's 20-year bond sale already triggered panic, spiking yields and wiping 800 points from the Dow in a single session. The upcoming 30-year auction faces even higher stakes, with traders eyeing the bid to cover ratio and auction tail as stress signals. If the yield clears too far above expectations, it signals that even required participants, primary dealers, aren't bidding competitively. And if that happens again, it suggests something far deeper than market indigestion. It suggests the US may have reached the outer limits of trust. But that trust isn't just about numbers, it's about narrative, and that narrative is shifting. Former Lehman trader and New York Times best-selling author Larry McDonald describes this moment not as a technical bond repricing, but as a global trust crisis. In a recent interview, he pointed out that the global majority is quietly rebalancing away from US debt, not due to rate speculation, but because they fear Washington has no intention or ability of reining in spending. With projected deficits climbing past $1.7 trillion annually through 2027 and political infighting over fiscal rules, the US is pushing lenders toward higher-term premiums to compensate for instability. This isn't a matter of yield curve inversion anymore, it's a slow-motion credibility collapse. And yet, the most unnerving question raises isn't whether the US can sell these bonds. It's whether the world will still be buying them 5 years from now. The United States is on track to spend over $1.13 trillion annually on interest by 2026. According to Treasury forecasts, a figure that actually eclipses what the government spends on defense. That's not an exaggeration, it's really just the cost of funding ballooning deficits in a market that now demands between 4.9 and 5.15% on 30-year paper. As Representative Massie warned on the House floor, very soon the government will be paying $16,000 of interest per family. While some argue this is manageable given reserve currency status, bond markets aren't buying the optimism. The term premium, the extra yield investors now demand for long-dated treasuries, has returned with force, indicating growing doubts about future policy stability. What used to be academic debates and fiscal policy circles are now showing up in real-time Treasury pricing. And if that spiral continues, borrowing could soon become the biggest line item in the US budget. Buried inside Trump's new tax and spending package is Section 8.99. Better known on Wall Street as the revenge tax, it proposes a surcharge on investors from nations like Canada, the UK, and France that the United States believes maintain discriminatory corporate tax policies. While Treasury insists it won't affect interest on sovereign debt, analysts at A.O. Shear and Davis Polk warn otherwise. According to legal expert Matthew Brown, many foreign loans contain gross-up clauses, requiring US borrowers to compensate lenders for post-agreement tax hikes. A 5% surcharge would force borrowers to pay $1,053 on a $1,000 interest obligation, eroding credit margins and triggering secondary costs across syndicated loans. As Carolyn Alford of King & Spalding notes, memories are long. Lenders won't forget who made them eat the tax bill. If Section 899 passes, it could catalyze a quiet exodus of foreign capital just when Washington needs it most. This isn't just a bond auction, it's a global trust test. The June 12th Treasury auction isn't a market event. It's a litmus test of America's credibility in a debt-heavy era. According to the Congressional Budget Office, net interest costs are expected to hit $870 billion in fiscal year 2025, up from $659 billion just a year prior, a 32% surge. And this comes as the US is on pace to issue over $2.1 trillion in new debt. This year alone, the second highest on record. The bond market knows this isn't sustainable. Investors aren't just bidding on bonds. They're bidding on the belief that Washington can maintain discipline despite $36 trillion in existing debt. With Bloomberg reporting growing structural fatigue in the Treasury market and Fitch warning of fiscal drift, the Thursday auction is less about clearing bids and more about measuring how much longer global investors will tolerate funding a government whose policy outlook keeps breaking its own ceilings. So May CPI rose 0.3% month over month, pushing annual inflation to 3.6%. And now, with the Trump administration floating new tariffs on $250 billion in Chinese imports, economists are worried that imported cost pressure could push the Fed right back into a corner. As Reuters points out, each 1% tariff shock could add 0.4
percentage points to core inflation, which would tighten consumer margins and increase volatility in long-duration bonds. Meanwhile, bond yields are spiking, not because investors are suddenly confident in growth, but because they're bracing for stagflation, rising prices with sluggish real output. That mix eats away at real returns on Treasuries, making 30-year bonds less attractive, even at 5%. If the Fed resumes hikes to contain inflation, servicing costs on newly issued debt could compound exponentially. But if it doesn't, the dollar risks even further depreciation. Either way, the market is really stuck between a rock and a hard place, and Thursday's auction could reveal just how little policy room is left.
When the May 20-year bond auction posted a tail of 3.7 basis points and a bid-to-cover ratio of 2.34, yields spiked instantly, sending the Dow Jones down 800 points, the worst session since April 21st. Wall Street isn't watching for an outright failure on June 12th because primary dealers are contractually obligated to buy, but they're really laser-focused on just how deep that tail runs. A wider tail implies weak demand and mispriced risk, and according to JP Morgan analysts, an auction tail over 4 basis points could trigger another round of repricing across corporate credit and mortgage markets. But here's the thing, the deeper risk lies in trend formation. If 2 weak long-end auctions happen in consecutive months, it signals that market confidence isn't just shaking. It's actually structurally deteriorating. That's the moment when the tail stops being just a metric and starts becoming a warning label. With Japan reducing its holdings of US Treasuries by $23.5 billion in the first quarter of 2025, and China selling down $18 billion during the same period. According to Treasury International Capital data, the message is pretty clear. Even the largest foreign lenders are hedging their exposure. Moody's sovereign downgrade in May only confirmed what a lot of people already believed, that the US fiscal path has really diverged from prudence. Trust in this context isn't sentimental, it's priced. It shows up in widening credit spreads, shrinking foreign bid percentages, and rising term premiums. According to the Wall Street Journal, foreign demand for US long bonds has dropped from 34% to 25% of total issuance over the past 12 months. That's not just a blip, that's a structural retreat. The question isn't whether this Thursday's auction will clear, it's whether the world still believes that lending to the US is a rational long-term investment, or just inertia clinging to the last vestiges of reserve currency privilege. But what if the real crisis starts after the auction? So here's the reality. If the June 12th auction ends with a weak tail and an underwhelming bid to cover, the shock will be immediate. But if it goes smoothly, don't exhale just yet. Because the deeper issue isn't about one auction,